firstly, welcome and happy Independence Day to everyone. I hope we will enrich your Saturday and make it a very independent year ahead for you as well. But as we've been discussing in the Slack room, there's so many messages going back and forth, things like PCR, OI, and IV, and standard deviation, and all of that stuff that's been happening. I think some of us would do well with just kind of going back to the basics and saying, okay, what options are and how, obviously the returns from AP's trades in the last 2 weeks have been quite spectacular. We've seen, less than 2 lakhs deployed, and we've seen a return of, well, I think more than 80,000. I'm not sure what the last count was, but it was a ridiculously high amount. So obviously one gets attracted, but obviously there are reasons for that success, and AP will probably will take us through how he trades them after my talk, and I will just go through the basics of what options are and how you can trade them. You can type your questions on the right, and I'll take them through the session. We'll have a Q&A round afterwards. We'll make it a little more interactive because I think you have much more questions than I have slides for. I'm going to quickly run through the slides. Let me know if you end up with something that you can, if you need something that I haven't answered, or if you think it's going too slow. Yeah, I mean that the idea is if you're in an office where you cannot react in time, option trading is going to be very difficult for you. At least the kind of trading that AP is doing will require a much faster, reaction. Whereas if you were to do something that was a longer term in nature, and we can speak about that, you would end up not needing to exit at the appropriate time, because it's almost like if you're trading. Okay, Supal, you can't hear me? Hello? Oh, I can. Oh, I'm sorry. I don't know if it is something that's wrong or. Okay, sorry. Okay, I think maybe temporary issues. Okay, so let's go back to the main piece. I'm going to take you through the basics of option trading and type the questions on your right. Let me now scale you through the absolute basics. Okay, what is a call? What is an option? I want to buy, say, Reliance at 900 rupees. This is an older slide, so Reliance was at 900 at that time. And strangely, that was about 3 years ago. So, Reliance hasn't moved much, so it's not been a very good call option, even if you bought it 3 years ago. So, I want to pay 10 rupees, which is about 1% of Reliance's stock price. But I want to buy Reliance at 900, but only if it goes above 900. So I want to literally say, yeah, if it's at 950, I want to buy it at 900. So this is a way. Okay, I think I'm having a problem with Suhas, who's saying who's saying some trouble has started. I'm just going to give him the link. I think we should have the link right here. I'll just post it on the chat room. Sorry, you just want to make sure that everything's on. Okay. So I want to buy Reliance at 900 rupees, but only it's above. So for instance, I want to say, listen, we're in August 15th. By August end, I want to buy Reliance at today's price, say 900, or even below today's price of 900. But I want to buy it only if it's above 900. So if it had gone to 850, I don't want it. So this is a call option where I will say, listen, this is a separate deal which I'm one person is making with the other, saying one person is the buyer, and he's saying, you give me Reliance at 900 at the end of the month. Only I will choose to buy it only if Reliance is above 900. The other guy will say, okay, I will sell you Reliance if it is above 900 or when you want it, but only if you want it at the end of the month, nothing in the middle. But for this, because if it goes down, the loss is mine. If it goes up, the profit is yours. I will charge you some money, the seller says. That seller says, give me 10 rupees for every share. So if Reliance goes up to 1000, you still pay only 10 rupees, but you'll get 100 rupees, because 900 to 1000 is 100 rupees. If it goes down to 800, you will lose the 10 rupees, but you will not lose anything more than that. So a seller is on one side of the trade and the buyer is on the other side of the trade, and you can actually be both. As in, there is no reason why you to think of option buyer yourself as, oh, I can only buy options. What about the remaining guy? So what happens is the option buyer gets the right to buy that share or that index at a certain price called the strike price. In this case, the strike price was 900. He bought, the option buyer got the right to buy Reliance at 900 from the seller. The seller has the obligation to sell Reliance at 900 to the buyer, and he receives the premium for this. So he collects the premium, but the buyer pays the premium. Now you might think about this, hey, wait, I don't have Reliance shares, so how can I sell them? How can I be a seller if I don't have it? In India, at least in where we are right now, we don't even do this share exchange process. What happens is on the day of expiry, which is when the contract expires, your price of Reliance at that day is considered to be the settlement price. Okay. So if Reliance is at 950, then the option buyer who's got the right at option at 900 rupees receives 50 rupees automatically. The option seller has to pay 50 rupees automatically. So there is no exchange of shares. What has happened is it just settled at that day's market price. So in a way, it's a little more speculatory than actually getting the shares. But the option seller gets to, I mean, this is called cash settlement. You just settle the whole trade in cash without actually buying or selling the shares. Hello, can you not hear me? Okay, one second. Let me just see if my audio options are higher. Hello. Okay, I seem to see something here. Okay, I just increased the volume on the, okay, sorry. Apologies for the audio issues. I think this should be much better. We will go a little bit further now, where we've gone from this thing. So there's two concepts in an option. Now, when I'm buying and selling options, obviously now there's a market, right? So in this market, I will buy and I will sell options all the time, and there's a traded price for these options. So consider the 8,500 call option when the Nifty is at 8,550. If the Nifty is at 8,550, then you see this. I'm not sure. Are you able to see my mouse? Maybe I should do this. Yeah, you can see it here. Okay, so you see Nifty is at 8,550. There is a strike price of 8,500. So it's called the Nifty 8,500 call option. Nifty 8,500 call option. If you bought it now, you would be paying 75 rupees. That's what the market price is. So what does this market price consist of? Is one is the intrinsic value, which is like, because Nifty is at 8,550 and you're buying a strike of 8,500, the difference between the two is the intrinsic value. That means if I got it and somehow managed to sell it right now, exercise, value the option right now, then 50 rupees at least I will get. Anything beyond 50 rupees is what I'm paying for in terms of the time value between now and expiry. Expiry being August 27th in this case. This is the last Thursday of every month. The difference between the price of the option and the intrinsic value is the time value. The time value is like 25 rupees in this case, and we are paying 25 rupees so that I can buy Nifty and at 8,500, and I will hold it till expiry. That's the thought process. Now here's what happens. Okay, if Nifty tomorrow falls to 8,510, 40 rupees fall, the intrinsic value would have collapsed to 10 rupees. The time value might have gone up or down. Typically, as the time reduces, time value will reduce as you get closer to expiry. But your intrinsic value has also gone down. So if it goes to 8,510 tomorrow and time value falls to say 24 rupees, the price of the option of 8,500 when it goes to 8510 will become 10 rupees intrinsic, 24 rupees time. So we're talking about 34 rupees. So the price would have fallen from 75 rupees to 34 rupees. Now, see what's happened. The Nifty has fallen from 8550 to 8510, just 40 points, right? And the Nifty 8,500 call option would have fallen from 75 to 35, 34 in this case. So it's fallen by half, while the Nifty has fallen by less than about 0.5%. So options are inherently very, very volatile and tend to gyrate in very high, ranges. So where you get very high percentage returns and very high percentage losses. You can't lose more than 100%, but even 90% is big. So 90% is very common in options. So you have to think of things a little more, as extremely volatile. So you take positions accordingly. How do you calculate the time value? Awesome. AP is in, so I'm just going to. Okay. No, I don't. Oh, I don't see him. I think maybe he's. Oh, okay, he's in. He's here. Okay. AP underscore 1. Yep. I'm going to just. Yeah, I'm leave. AP, hi. I'm just continuing the presentation. Once we finish, I will transfer this over to you with the mic and the mic control. That will work, I think, and writing as well. Cool. So, how do you calculate, time value is, 1 second. We've got 4 things that impact the time value. First is the volatility of the underlying. So, for instance, the Nifty, moves between 8,500 and 8,000, maybe 800, 8,200. It's still moving 300 points on each direction. 300 points for 8,500 is about what, 3%. However, you look at a stock like L&T, you look at a stock like Reliance, you look at a stock like, Kaveri Seeds, for instance. These are stocks that will do 5, 10, 15% between expiries. So within a week or 2 weeks, they might move 10, 15%. The volatility of the underlying means that I will need to pay more for a very volatile stock in terms of time value. So if Reliance, I'm happy to accept 10 rupees for the next 13 days of time value. For Kaveri Seeds, I will demand 40 rupees. As a percentage, maybe Reliance is 900, Kaveri Seeds is about 550. So instead of 10 rupees, I will ask for 20 rupees, which is 4% of Kaveri Seeds value versus 1% of Reliance's value for the same time frame. Second thing is, of course, as the time changes, the remaining time value obviously will change. So if I started in the beginning of August, I will pay more for the time value because the stock has a lot more time to be volatile versus just being a tiny amount of volatility in terms of if you're 1 day or 2 days ahead of around expiry. Then also, what happens with options is a person who is writing an option has the concept of saying, listen, I can write this option and receive a premium, or I can keep my money in a fixed deposit. In a way, if my risk-free interest rate is right now about 8%, if that 8%, which is something that's really short-term, let's say short-term interest rates, so short-term interest rates currently about 7.5%. So I can get 7.5% for my money versus putting it into this option trade. So if my risk-free interest rate is higher, my time value will be higher. If my risk-free interest rate is much lower, apologies, my interest, my premium that I will demand is also much lower. So in India, for instance, if I can get 8% risk-free, then I will ask for at least 12% when I take risk. So that means 1% per month. So that means out of my Reliance 10 rupees that I'm asking for, 9 rupees is literally the value that I would ascribe to just holding that Reliance trade for a month. Now it's half a month, so half a month means 5 rupees or 4 rupees 50 paisa. Half a month, I want at least 4 rupees 50 paisa just for the risk-free interest part of things. The rest of it will come in from the volatility and time and so on. And then there are two kinds of options: this call and a put. A call and a put has different, you know, structure. So I would actually demand a little bit more for a put than I would for a call in general. And then whether it is American or European, American means that I can exercise it anytime. This used to be the case in stock options in India earlier, but since 2013 they have changed this to use only European options. European means you have to exercise only on expiry day, nothing before that. So the seller is not obligated to give the buyer the money or the shares or whatever it is, or settle the contract any time before expiry day. So you have to wait till expiry. So stock goes up, goes back down, and you keep holding the option, you will lose money. So, okay. From IE to Chrome. Okay, cool. So we've got, how much you pay for volatility between now and expiry is what effectively impacts your time value. And there are lots of ways to calculate time value. The most important thing is, so see, you don't know how much to pay for an option, right? But there's a market price already for every option. That market price tells you what the market is expecting of volatility going forward. This is what is called implied volatility. So what is the market saying with a 10 rupee price on a Reliance option, that how volatile will Reliance be in the next X days? X days being number of days to expiry. That is the market's expectation. It's not really what's going to happen. It's like, because markets expect a lot of things, but not everything happens. So the current option price implies a certain kind of volatility that is expected in the stock, and these are calculations to them very complex. So if you assume that the market works in something called a bell curve. A bell curve is, if you're not familiar with a bell curve, the concept over here is that everything in the world that is, most of it which is natural, fits into some kind of a bell curve. So if you count the number of people, say you take 1,000 people and you measure their heights, they will be an average height around which most people are concentrated. So you may have 500 people within 5 feet 3 inches and 5 feet 9 inches. You will find lesser number of people between 5 feet 9 and 6 feet 2. You will find a even lesser number of people that are 6 feet 2 to 6 feet 5, and then very less above 6 feet 5. Same thing on the other side, you will say, less than 5 feet 3, lesser number of people, less than 4 feet 8, very few number of people, and then so on. So the curve becomes some kind of a bell curve, and I can show it to you. It becomes approximately like this. If you draw the number of people on the y-axis in various ranges, and on the x-axis you have the heights. So I'll actually come back to implied volatility once we get to standard deviation, but here's where the concept is. If you take the average and draw one standard deviation is 32% on each side, or 34% on each side, 68% of the time of the number of observations will be within one standard deviation of the mean being the average. So a stock's average, let us say, is the current price, because just to give you a holding point, and its movement will be one standard deviation to the upside and one standard deviation to the downside in 68% of observations. That's what the bell curve signifies. Now, stocks don't always follow the bell curve. The bell curve uses a normal, or in fact a log normal distribution. But this is how most natural things, like number of people with a certain height, the average death age of people, and things like that. There's always most of these follow a bell curve unless something strange happens. Like for instance, if you're calculating the death rate of people, the age of death of people, there will be a mean and there will be a standard deviation on one side, standard deviation on the other side. If there is a massive catastrophe, obviously there will be more people dying than expected. at much lower ages or much higher ages than we had expected in the first place. So there will be I mean, those events that happen can change things. In the stock market, these events happen all the time. There are always big surprises. You'll always find like a Kitex falling 40% after not really falling 40% for the last 2 years or 3 years. Or you will find, like we saw in some of our stocks, we've seen an Ambika cotton go from 672 to 1200, and in 4 days is back to 890 or something. So it's like extremely volatile. Those moves are not something that will probably follow the normal distribution and the bell curve. However, bell curve is usable for options because you can find out what options imply as the expected one. I'll come to that. Now, if you go to the NSE website, and hopefully soon we'll show this on the Capital Mind Snap website as well, you can see the implied volatility in the price using the Black-Scholes and binomial methods of calculation. So we'll calculate it for you using all those things: number of days left to expiry, the stock strike price that of the stock, the current value of the stock, how much is the risk-free interest rate, and so on. So we'll use this and figure out what the implied volatility is. It could be 18%, 22%, and so on. We can use this to find out what one standard deviation move is expected in the stock. One standard deviation being in 67% of opportunities, 68% of opportunities will be within the one standard deviation move is what the expected move is if the stock follows the bell curve. If the implied volatility is very high, the expected volatility therefore is very high. So the market expects the stocks to move a lot. So in INFI, for instance, we'll see a spike to 40%. Now 40% is a lot because an average may be 21, 22, 23%. IV itself is very, very high. When you're using Infosys just before results. But to calculate how much that 40% means in terms of an actual point move, look at a calculation on the right. You got stock price into implied volatility into square root of days remaining to expiration, and divide this by under root of the number of days in a year. That's because implied volatility is a calculation based on an annualized move. Use a square root to smoothen out the ups and downs. It's a variance calculation. So what happens is the Nifty is at 8509, let's assume. I think it is, but let's assume that if you see this on another day. The implied volatility of an option, let's say a call option, is 16%. So what is the 8500 call option actually saying to you? It's saying that multiply these numbers, 0.16 being 16% in decimals. 13 days is what is left to expiry. So under root of that, square root of that, square root of 365. Do the calculation. It says 256 points between now and expiry, which is August 27th. Today we're 15th. So including today, 13 days. There is basically one standard deviation move means either plus 256 points or minus 256 points. The market is expecting that a 67% of times it is likely to move to 8,509 plus 256 or to 8,509 minus 256. That's the range that it's expecting to move at. Given that the options are priced according to that kind of a move, that's what the market kind of expects. It assume that the SD is actually 34% on each side. So 256%, 256 points in that case was actually one SD on each side. So it's total 512 points range that the Nifty is expected to lie in. I'm sorry, I think that sentence didn't come in through the last one. The normal distribution is assumed is what is very important to know, because normal distribution does not necessarily happen. Okay. An option says that Nifty's 1SD move is expected to be 256 points. Today, 256 about 3%, let's say. It won't necessarily be in that way. If you look at this graph, this is the number of 3% moves in 9 days. Actually, I've used 9 days because it's 9 trading days. 13 includes 2 weekends. So 9 trading days. I plotted this over the last 2 years. You can see how, these moves are concentrated and bunched. So you don't really have to, you can see that this part here saw a lot of moves of 3% in 9 days. Whereas there was very little here at all. There was no downside 9%. There was no upside 9% here. And this part saw very little in the first place. So in 2 years, you saw 135 out of 493, which is about what, 33%. So that means 67% were within, or 30% in this case. Which means 60, no, it's less than 30%. It's about 28%. So that means 72% of the observations were that it moved less than 3% in 9 days. So making that bet, saying that 68% of the time will be in 1SD range was a good idea if you look at it on a 2-year purpose. But look at what happened in March and April. Look at just those 40 days. In those 40 days, you had 16 days in which the market moved more than 3%. And all of it was on the upside, as you can see. The market moved up quite a bit. So if you look at it in that short-term range, then you lost money, because in those cases you would have, if the 1SD bet was 38% or 67% expectancy to stay in that range, here it is 40% that was outside the range. So only 60% was in the range that we expected. So it didn't follow that normal distribution during that smaller time frame. So it's not necessarily going to happen that way. Then we've got the concept called open interest. We'll talk about a lot. A concept is, let's say you start off with 0 contracts. All of F&O's contracts. As I said, we don't actually exchange shares. So we create a contract. One contract says that, boss, I will buy this option. On the other side, the guy says, I will sell the option. This one buyer and one seller form one contract. If there are 5 buyers, there are 5 sellers. What you hear about as volume is 5 contracts. Open interest is also 5 contracts. There are 5 open contracts at this point. Now let's say there are 5 buyers and there are 5 sellers. One of the buyers decides to say, I want to sell my option. And instead of the actual seller on the other side, you don't know who the seller is on the other side because NSE assigns them randomly. It's all anonymous. But if you say, I want to sell, I place a sell order on the exchange, and somebody new comes in and buys it from you, he becomes the buyer. You are out of the system. The number of open contracts is still 5. You've gone out, new guy has come in, and there's still 5. There's a volume of 1, but the OI remains the same. Right? And then you've got the issue of, let's say, one current seller and one current buyer both want to square off their contract. Maybe the contract's going down or up. Or one of them wants to book profit or book the loss. They book it with each other. Now open contracts has fallen to 4 and there's a volume of 1. And now there is a new buyer and a new seller of the contract. The volume again is 1, but the OI goes back from 4 up to 5 again. So volume and OI are different. So for instance, volume can be going up while open interest is going down. What that means is the number of contracts that are getting out of the system are much more than, so you may have built up contracts over the last 10 days and today all of them are getting wiped out because of a sudden move and people want to book their profits and they want to get out of the system, and the sellers are saying, okay, it's time to exit our positions. Things are getting more volatile than we thought, and then everything moves to the long option, so the long option guys and the short option guys square off their contracts. The OI can be coming down, but volume is going up. The put call ratio is something that we talk about quite often. It's basically the volume of the puts in the system divided by the volume of the calls in the system. This can be for the entire stock across all contracts, or for the entire stock across only the, by the way, there are 3 expiries in India at any given point in time that we have to be careful about when you talk about stocks. That is the current month, that is the immediate next expiry, which is the in last Thursday of any month. There is also the subsequent month, which is 1 month later. So right now, current month will be August, next month will be September, and far month will be October. So September, October now, August, September, October is the contracts that we care about. In the index, they actually open out a lot more contracts in the longer term for the Nifty. So you can actually see December contracts, March 2016, and because they just open up these longer term contracts only for the Nifty. So the put volume, I can say, give me put and call volume for across all contracts of Nifty or across all contracts in the August expiry, or give me the put volume divided by call volume at every strike price. Give it to me at 8,500, give it to me at 8,600, give it to me at 8,700. Rajesh has a great site where you can actually see the for every stock what are the put call ratios at every strike price. You can also see them in Options Oracle, which, by the way, I'm still having problem with, because I think some people are having problem with in different places. I'll come and talk to them. We'll try and fix this issue once and for all, and you'll be able to use it, and we'll distribute it for free on the net also. So it's just a great product. I think we can demonstrate it later if you guys like. We can do put call ratio by volume, which is the number of contracts traded, versus we can do put call ratio by open interest as well, OI. So there's a difference, and the difference was we saw last time. Volume can be different from open interest. So these are just basics, so I'm not going to kind of run through a lot more. I'll just take this quickly now. When you buy an option, you only pay premium. You don't have any other downside. There's a much lower cost. But then, given the fact that you end up buying an option for a certain premium, many of them will expire worthless because, and that's what happens. People try to think that I'll pay lower price, so they will say Reliance is 900. Give me the 1050 call option. So unless Reliance goes to 1050, that option is going to expire worthless. Or they will buy a put option, which is giving them profit on the downside, saying give me an 800 put option, 850 put option. Reliance is not likely to go there, so a lot of these options will expire worthless. So it's a bigger risk. And then you have the time decay, because you know that for every day that you're coming closer to expiry, you're going to lose time value of the premium. So instead of paying 75 rupees or 20, by every day you might be losing 2-3 rupees out of that 75 rupees if the Reliance doesn't move to your price very fast. When you sell an option, your upside is capped to the premium. You can't get anything more than the premium. That's the maximum you can get. But your downside is unlimited. However, because your downside is unlimited, the exchanges demand margin like futures. But there's no M2M payment, so it's not like if the stock moves against you that you have to pay more money. It just increase margin. There's a difference. The difference is that when you have to pay MTM, you have to pay in cash. If you have an increased margin, your margin can be used in stock. So you don't actually have cash flow that's going out. So that's great. We have Kunal here, in fact, in the office. So it's quite amazing. Welcome, Kunal.
Thank you.
So we also have, when you sell an option, there's a risk, which is an opportunity if you're buying an option of events. So Infosys event is a huge thing. So 10-15% moves are common. We saw this when we bought an Infi option on Infi results this time. The 15 rupee option went to 110 rupees. So the guy who sold it got only 15, but had to pay out 110 rupees, 120 rupees. So he lost 100 rupees on that contract. So the event risk for the seller is much higher. The same seller will probably next time ask you for 100 rupees for the same contract because it's been burnt once before. Then the risk becomes, if Infosys does not announce a spectacular result or a spectacularly bad result, you don't make any money because you pay so much more premium. Payoff graphs are interesting to look at. On the x-axis, you have the price of the stock. On the y-axis, you have the profit you make or the loss you make. When you buy a call option, in this case, you bought a Nifty call. This is a very old slide, so 5100. You paid 60 rupees on a per Nifty basis. You can see over here that you will keep losing 60 rupees if the stock goes lower and lower, if the index goes lower and lower. At 5,100, you start making lesser losses initially, until it reaches 5160. After 5160, it's only profits. If the Nifty goes up further, you make a lot more money. And then the put option is the exact opposite. Over here on the right hand side, you see the put options where you make money if the sorry, this is selling a call option. This is selling on the right hand side is selling a call option. So you've sold a call option at, say, in this case, it's a stock at 200. Below 200, you make the full premium, 12 rupees 60 paisa. Above 200, your profits reduced till 210, 12 rupees 60 paisa, obviously. And after that, you just start making losses. So this is all from Options Oracle, by the way. In case you guys want to do this, you can just look at the graphs there. And then we've got covered calls where you buy a stock or buy a future and then short a call. In this case, you see the payoff, the 45-degree angle dark blue line is the stock future. Stock goes up, you make profit. Stock goes down, you make loss. Very straightforward. 45 degrees because it's proportionate. 1 rupee stock goes up means 1 rupee loss. Sorry, 1 rupee profit. You bought the stock future, so it's 45 degrees pointing upwards. And the short call, like we saw, is this purple line. If you combine them together, the stock, which has an unlimited downside, continues, but at the strike price at which you covered the call, it evens out. It reduces your profit to a maximum of that much. So you see, let's say there's a stock which is at 210, and you think, okay, well, it's not going to go above 220. I'm hoping you're all able to hear it. I haven't seen anything on the right, so okay. So if you I'll just extend the class by about 20 minutes. Okay. So you got on the right, I mean, you got a covered call which tells you that on the upside, I get only a certain amount. The stock goes about 220, I will only get 10 rupees. Anything above that, I will not get because I have to pay out on the short call. But if the stock goes down, I get all of the losses. But I can reduce the losses. You can see here the losses are lesser at any given point. At 200, if I only own the stock future, I would have lost minus 10,000 rupees. Versus I lose a little bit lesser if I have the covered call. So I reduce my losses on the downside, but I cap my profits on the upside. The reason you do this is you think the stock's running out of steam and you don't want to sell the stock. You think there's a long-term opportunity here. But until the stock is going to be stuck in this range, you might as well earn some premium. So you keep writing these calls every month, earning a little bit of premium until the stock decides to break out, at which time you stop writing the covered calls. And then we talk a lot about this in terms of straddles, mostly on short. This is a long straddle. Long straddle means you buy a call, buy a put, same strike price. You went long a put at 6 rupees 75 paisa. You went long a call at 6 rupees 65 paisa. The payoffs of the individual puts and calls are here. You combine them together. What happens is at 210, your loss is the highest. 6 rupees 75 plus 6 rupees 65 is 13 rupees 40 paisa. So 13 rupees 40 paisa will be your loss. Anything that is, if the stock goes above that, until 223 rupees 40 paisa, you will make lesser losses. Above that is a profit. Again, on the downside, if the stock goes down to that minus 13 rupees 40 paisa, so about 196.60, you will make lesser losses. And then beyond that is just profit for you if you're long. Similarly, invert this from a V to something like this. That becomes your short straddle payoff. So you're betting on the stock going out of this range if you're longer straddle and staying within this range if you're shorter straddle. And a similar concept becomes a strangle. A strangle is simply where you don't write at the same strike price, you use different strike prices. So instead of putting 13 rupees 40 paisa, I think is a lot of money per option. I say I want to put only 3 rupees on the put and 2 rupees 75 paisa, about 3 rupees on each side. So it's 6 rupees. So what I do is I extend the strikes. I want to buy a put at 200 and buy a call at 220. So what happens now is my break-even point goes further. Instead of 223, it becomes 226. Instead of 196.6, it becomes 194. But I pay lesser. I pay only 6 rupees per stock. Things you need to watch out for is if you we've talked about this on Slack, but as we get closer and closer to expiry, time value goes negative. So if you're long an option because of securities transaction tax, the option may trade less than intrinsic value. So Nifty can be at 8,500. Nifty in 8,400 call option, which should technically be trading 100 at 100 plus time value, will be trading at 94 rupees. There's a reason for that because the time value by near expiry will come close to zero, and because of STT of 6 rupees that applies if you hold the option all the way to expiry, people actually pay lesser than the 6 rupees as as the premium for that option. So that's one thing to watch out for. There's something called a market-wide position limit. This is announced every day. Number of stocks that are reaching it. This is typically 10% of the non-promoter holding of the stock. When a stock gets to 90% of its that is number of shares open interest is at 90% of this market-wide position limit, then no fresh contracts will be issued. That means if you buy a call, if you want to buy a call, you cannot buy it because there are no new contracts that are going to be created. What can happen is if you own it, you can sell it, or if you've shorted it, you can buy it back, but you won't be able to create any new contracts for it. So that's another thing because that affects the stock price, because now if you're getting liquidity on the sell side, new people are coming in selling. With market wide position limit coming, those sellers may not be able to sell, in which case the price will go up. So if you're a seller, you got to be watching for that. The dividends in general reduce the stock price. Typically, if it's more than 1 or 2%, the stock price impact can be quite dramatic. So for instance, if I think 3 years ago, the Hero Moto Corp gave a 100 rupee dividend. Price was about 2,000 rupees at the time. So its stock price was at 2,070, but the 1900 call was trading at 50 rupees. So because they knew that after the dividend, the stock price would fall from 2040 to 1940. So they adjusted it automatically. So it looked very strange. And the IVs, when you calculate them, because you calculate them against the stock price, they look very strange. They look like, oh my God, I'm paying only 3% IV for this Hero Motocorp call option, but it's not actually true. You have to adjust it for the dividend. Many of the online sites don't do that, and that's why I was going to warn you, because you want to be careful about it. And then you got infi results, for example, where there's suddenly historical risk only at results time. So every 3 months, you will find the option implied volatility spike. They drop after the event. So SBI dropped 3% or 4% after results, and then some options didn't make money at all because the drop in implied volatility, time value collapsed, and what you paid 8 rupees for in one case became only remained at 8 rupees, even though the Nifty the SBI had fallen by 8 or 9 rupees because the time value collapsed. The time value portion of the option value was much lower. So that's, I think, about what we have. I'm going to pass this over to AP, but if you have any questions, just type it on the right hand side. We'll have a small round of Q&A later as well. Pankaj, yes, I'll share the PPT as well. I will send this across. AP, can you hear this? I think now you can talk and we can hear you as well. Could I explain the explain the 1SD on the Nifty graph? Okay. Um, okay, two quick questions here. One is what's the difference between what is the SD again? So the ST is just a standard deviation. The reason it's called standard deviation. Okay, like we go back to has the concept of the bell curve clear, where things kind of fall in approximately a bell curve motion. I'll send a more detailed link as well. I think Vashish had shared that. There was a Zerodha article on how the bell curve works and the number of points. If you take the average Nifty move on a daily basis, and you plot it for the last 10 years, a number of points between say 0.1% up to 0.1% down. So you've got yes, okay. So the Nifty, okay, so the bell curve. Okay, so what our option was pointing out was, according to, I used the price of the Nifty, let us say, to calculate the implied volatility. The implied volatility was 16%. When it said 16%, how much does 16% actually mean with respect to a one standard deviation move? How much does it mean that the market expects the Nifty to move in one standard deviation? You use this formula, you say it expects the market to move 256 points. 256 points is about 3% in either direction, right? The question is, has the market moved 3% in either direction a lot, or has it moved less? This is called historical volatility. Now the market expects it to move 3% in the next 16 days is what we know from the option price. But in the past, has it moved 3% in say 13 days? In this case 9 days, because it's 9 trading days. If you look at the past, you see that the number of points above 3% are marked here and below 3% are also marked here. They are, I just put them in a graph so that you don't see the intermediate points. You just see the number of moves that are only above 3% up or below 3% down in 9 days, not overnight, 9 days. That means today to 9 days later or today to 9 days earlier is the 9-day move as of today. If I mark these points here, you see that in 9 days, yes, the market has moved many times, but over the last 2 years, it's only been 135 points out of 493 observations since August 1, 2013. So we're talking about approximately 28%, 27, 28% of observations have been more than 3% in 9 days. That means 28% has been more than 3% in 9 days, means 72% are less than 9%, less than 3% in 9 days. So that means out of 493, 135 if you remove, that's approximately 360 something. So 360 out of 493 are within the 3% range in 9 days, which means 72% are within the range. Now what did we say 1SD move was? 1SD move would have comprised of 67% of observations, 68% of observations. 68 times out of 100, the stock will remain within that range. That is what we expected according to the bell curve. So we are saying that in the past 2 years, if you see, this has been justified. But if you look at March and April only, so if you try to do this analysis in March or April, if you had used this calculation in March or April and said, oh, it won't move 3% in the next 9 days, but in those 2 months, we saw 16 out of 40 days where the 9-day move was more than 3%. So that it's not sacrosanct that it will work in every time frame. It may work in the longer term, but that means that your short-term option position may lose money because it didn't work in that short term, right? So if you buy a 2-year option, the bell curve may actually be more valid than if you buy. I'm just saying this, but it's not actually true. In a sense, in stocks, for instance, you can see much higher volatility. So don't use that as a sacrosanct measure. That's what I was trying to say. There was one more question. One was the difference between the short and the long put. Short put and long call. Okay. 1 second. Just move certain things over. Okay. Okay, can it be interpreted that given the probability buying option outside 1SD will probably result in a loss? Probably, the word probably being key here, yes. But in case you have information to the contrary, the chart may be indicating a sudden breakout, for instance. At that time, volatility, the SD will be low because the SD takes a certain look back period and calculates the SD, the volatility. The 1SD move will come when you know or you believe that this 1SD will be broken because volatility has changed character. So, for instance, if a stock was moving in a very tight range, suddenly starts breaking out, you probably think that, okay, going forward, I think the stock is going to burst to the upside, in which case buying the 2SD call may actually give you a great return. So it shouldn't be normally interpreted like that. The difference between a buy call and a short put is, sorry, a buy call gives you limited downside, unlimited upside, but you pay a premium for it. A short put gives you limited upside. Only the amount of premium that you have purchased, you have received, will give you the upside if the stock moves up. But you have unlimited downside. If the stock goes down, you have to pay out. There are differences also between in buy call you only pay the premium. In short put you get the premium, but you have to pay margins to your broker. And that margin will change every day until you exit the thing. Tax implications of option trading, I think it's all business income as far as I know, unless you are hedging. And if you are hedging, you really need to have a very solid hedging book. Your auditor will ask you if you've done anything other than a pure hedge, then it will probably apply as business income. If you make it a pure hedge, then it can be used as capital gains. That is, you can offset it. However, the tax department has taken a very negative view on much of this. So in almost all cases, I've seen it used as a business income. Will IV increase in that case? Well, IV will increase. I mean, IV is a function of whether how much volatility the market expects. The market is not always right. So you could have a different expectation than the market, for instance. Okay. So one can buy a call at the beginning of the month in a stock future that is not much downside and hold 4 days before expiry. One can get minimum 4 times. Krishna, I think we'll have to test this because I'm not sure if that is, how do you identify a stock future which has not much downside? Because if it does not have much downside, then that's pretty good analysis by itself to have. So having that analysis and then using that to say do a call option, covered call is like fantastic. But yes, you're right. I mean, writing calls has been a very good earner for the last few years as well.
Yeah, can you hear me now? Okay, I changed the mic. There was a default setting which was not working.
Yes. I see. Okay. I think, yeah.
Greek and Latin. I mean, that is the science behind the options. I jokingly call it like even in stocks you have fundamental analysis and technical analysis. What Deepak talked about was, in my opinion, is the fundamental analysis of options. Whereas what I generally do is the technical analysis of options, which is purely based on charts. Charts of the stock, I mean the cash or the futures or the options chart, including the call option and the put option. So, and like in any stock, you can say, fundamentally it is overpriced or underpriced or whatever. If you see the cash chart of any stock, whether it is Reliance or even if there is a stock which is not in futures and options, the chart gives an indication of what is going to come in your future or how it is looking on the even for the long term. Like for example, I shared the DLS chart yesterday, and unfortunately it went up 17-18% yesterday. So if you have an idea of take grasp of reading charts, or even if you take help of oscillators and indicators, you get an indication that a price of the stock is going to move up based on some parameters which you might have defined yourself. So same way, same thing happens in options. If that's why I call it the technical analysis of options. So there is no Greeks involved, there is no standard deviation, there is no implied volatility. I only take help of some amount of the PCR. Again, that is a bit different, because typically people are used to talking about the PCR, which is the overall PCR of Nifty. Whereas what I do is I talk about PCR of individual strike prices, because I have seen over the years, overall PCR gives you an idea of the direction of the market, broad direction. Whereas the individual strike, PCR at individual strike prices. Sorry, Sridhar, is it clear now? Okay. Overall PCR gives an idea of the direction of the market, whether it is bullish or bearish, that's fine. But then when you break down the PCR to individual strike prices, I have seen you can get idea of the support levels and the resistance levels of the market. For example, about 10 days back, it was quite clear that crossing 8,600 or 8,700 is going to be difficult, because the put call ratio at that level was very weak. Any put call ratio above 1.2 is, in my view, is a bullish put call ratio. Any put call ratio below 0.8 or 0.9 is a bearish put call ratio for that strike price. And then market declined to 8340 or whatever, as per the chart also has the support. And that is where the put call ratio was quite strong. I think it was more than 3 for 8,300 strike price. So that was one indication that market will take support there. So that's how I use the put call ratio. But otherwise, I need to explain some basics of options trading, which a lot of people keep asking. As Deepak suggested, there are two ways of trading in options. One is long options, one is short options. Now, in long options, there are what you need to keep in mind. In long options, the loss is completely known. If you have bought a call option or a put option for, let's say, 5,000 rupees, there is no way in the world you can lose anything more than 5,000 rupees. So that if you want to take a blind bet with something, maybe some stock or the index, it will go in this direction, let's say it is going to go up, and then you buy a call option for 50 rupees, maybe 4 lots. So completely the total loss cannot be more than 5,000 rupees, even if the index does not go up or it expires below that strike price, which means that call option will expire at 0 on expiry date. But in spite of that, what you will lose only 5,000 rupees. At the same time, the gains are completely almost unlimited. Let's say you are lucky and Nifty goes to 8,800. So that call option of 8,500 which you bought at 50 will go to 300. Yeah, I will show some charts, because what I am going to show is only charts, nothing else. I don't have these kind of technical and scientific data to share. So it will be only, so let me finish the introduction, then I'll go to charts straight away. So coming to long options, where the risk is completely known, limited, you cannot make a loss beyond below a certain level, and the gains are completely unlimited. Exactly opposite is there in going short in options. Let's say yesterday, when it was quite clear that the market is going to go up, maybe as I said on the Slack room, in fact, the day before yesterday also it was there was an indication that market is going to go up. Instead of buying a call, if someone had bought a put, shorted a put, sorry, because that is shorting a put is bullish. So there, let's say if you had shorted 8,600 put, which was I think 200 rupees. So in case market had not gone up and had gone down further, that 8,600 put would have gone up from there. And let's say market had Nifty had crashed to 8,000. I'm just giving you an example. That put would have gone to 400 rupees. So if you are short at 200, that going to 400. So which means the risk is unlimited. Nifty can go anywhere and will carry the put along with it. Whereas the gain is completely limited. in shorting options. Let's say we carry this put short and it keeps going up and expires above 8,600, which means that 8,600 put will expire at 0. So your gain is only 200 rupees, which is limited. It cannot be more than 200 rupees in any case. Your risk is quite far off. I mean, it's almost unlimited. Let's say whoever was in the market in January 2008 will remember how Nifty had crashed from 6,300 to I think 4,900 in 1 month. So imagine someone had shorted puts at even 6,000, maybe let's say 100 rupees at the top. That would have become 2,000 rupees. And any indisciplined person who doesn't follow stop losses, you can imagine what his account would have looked like. So this is the basic difference between long options and short options. And that is exactly the reason why more of retail buy options, because as an example, like yesterday we bought the 8,500 call at 51 rupees, let's say 50 rupees. One Nifty lot is 25. So for 1,250 we bought one Nifty, which is worth 2.5 lakh rupees. One Nifty future costs 20,000 rupees, around 18 to 20,000 rupees. Same way, the value of Nifty is I think more than 2.5 lakh rupees. We bought one lot of Nifty for just 1,250. That is the basic attraction why people go more for buying options, because you don't need a lot of money. But then people don't realize that if they do it wrongly, that 1,250 can become zero in no time, especially near the expiry. So that is something which I use more. Charts are quite indicative for me. It's just a question of how you read the chart. To know the basic difference between going long options and short options. Now what happens is when an expiry starts, initially the open interest and the put ratio doesn't have that much meaning, because whoever has watched boxing on TV or maybe even live, when the two boxers enter the ring, what they do for the first few, maybe half a minute or so, is sparring at each other. So the call writers and put writers towards the end of an expiry for next settlement and towards the first few days of the new settlement, they are sparring at each other and creating their own levels. Like we saw when this expiry of August started, they were not sure whether that time I think Nifty was at 8,400 or so. So they had, you can read, or maybe even from the NAV side you come to know which is the strike price where the call has the highest open interest and which is the strike price where the puts have the highest open interest. So which means broadly saying one can conclude that that is going to be the range for that month, and going beyond that range is going to be a bit difficult. So what they do is they take, let's say they are at the lower end of the range at the start of the month, maybe around 8,300, and the maximum OI of put is 8,200. So which means we are at the lower end. Now, since the support from the put writers, which is bullish, is strong, market will go up. And then we will test the call writers at the top, the higher side of the range. Let's say this was, I think, in fact, a few days back it was around 8,600, 8,700. So which when market went there, that was also tested, and there the call writers were stronger than the put writers, and then market came down. And again it tested the lower side. So this kind of sparring goes on for the first 1 week to 10 days. And then they base maybe on some trigger, maybe news or some event, some result, something, and then market generally takes direction. Sometimes there is no event, there is no trigger, or maybe the trigger or event is not good enough to break that range. Market will remain in that range throughout that month. And that is exactly what I felt this month. That's why of course we'll come to the strategy later. But based on the options charts, I had got an idea that market will not cross 8,650 in a hurry, and market will not break 8,300 in a hurry. So we were in that 350 range, which was indicated on the options chart almost in the first week of August. That was the basis we were working on. Unfortunately, we had that put at the top, and I still can't understand why I gave it up. But that 8,500 put, which was at 50, became I think almost 200. And I think yesterday 8,500 call, and since it was the lower end of the range, that also was worth 50, 8,500 call. That became, I think, 120 yesterday. So this is how you have to judge the range of the month. But then this, you don't need to use any statistics or mathematical formula for that. The options charts are good enough once you get a hang of how to read those options charts. In fact, even hourly charts are good enough. I'll just share the options, the chart now. So it's asking me to download some app. Okay, I'm just doing it.
The screen, I think that's
Problem with webinars in India is you are completely at the mercy of the internet.
which is the sad part. Yes,
Yeah.
I think.
Skype has this by default, right? This you can share screen on Skype easily.
Correct. Yeah, this thing needs a Java thing on top.
Okay, till the time it is getting down. Am I audible?
Either my fault. Yes, he's already.
What you see on the chart is also mentioned in the slide room. I think someone has pinned it out. When a trend is about to end, I mean reverse. Let's say last week there was an uptrend which went up to 8,000, whatever it was, around 8,500, 8,600. It was topping out. There we saw that there was a topping signal. The first signal or the first hint comes from when the uptrend is going to end. The first signal comes from the call charts of the call options which show a topping pattern. Maybe on hourly charts or even on 15-minute charts. I shared some charts yesterday where it was exactly the reverse. So when an uptrend ends, the first signal comes from the call charts which show a topping out pattern. Then you get a signal on the actual index, maybe Nifty Spot or Nifty Futures, which shows a topping out. And then eventually you get a buy signal. Let's say someone uses moving average crossover or something, or maybe crossing off certain levels on the downside, breaking some level. Those signals on the put chart will come the last. So this is important to keep it in mind forever. An uptrend is ending. The first hint is from the call chart topping out. The second hint is from the index itself or the index futures. And the third confirmation is when the put chart give a buy. So that is the conservative way of doing it. Exactly reverse is when the downtrend is ending, which happened 2 days back on Thursday. The put charts gave a topping out signal, which I shared in the Slack room. 8,400, 8,500. I mean, there you can see maybe 2-3 strike prices, and more or less almost all strike prices give the same signals. Let's say we were at 8350. So first look at 8,300 itself because that is the nearest strike price. Then have a look at 8,200, 8,400, 8,500. Let's say 3-4 strike prices in the money and at the money and out of the money. And once you get used to looking at these charts, it doesn't take too much time. Just a couple of minutes is enough to find out what is happening, whether there is any change or a potential change in the trend. So on Thursday evening, in the second half of Thursday, the put charts have given an indication that the puts are topping out, which gave an indication that maybe Nifty is bottoming out. Because puts topping out means Nifty is bottoming out. And then the call charts did not give a buy indication on Thursday, but that is a place where you can take a calculated risk, saying that the put charts are giving a topping out pattern. Nifty is at a very strong support, which even as per market profile or even the weekly charts and the monthly charts, which are also shared, was a very, very important level. So based on that, there was a very good calculated risk to go in for a call option because the risk is limited. You can take a small risk of, for example, I gave that 8,000. I'll come to why which strike price later. So when you say 8,500 call, that time Nifty was 8,380, I think. It was just two strike prices out of the money. So that was, it was only at 50 rupees, and the risk was not even 20 rupees. I think the stop loss we gave was only 10 rupees. So that was the risk, and eventually it worked yesterday. But the first hint works on the put charts. That is what I wanted to highlight. You see the app has been downloaded. Yeah. Just installing it.
Yeah, if you share it with me, I'll put the PPT in. You can actually upload the PPT. Otherwise, you can share it with me.
PPT, and why the reason I didn't make any PPT was I'll be showing lots of charts and I really can't see which chart. So that's why I'll be giving constant examples of the actual chart.
Got it. Okay, is the Java thing not working?
No, it's installing now. The app is installing.
Okay. It takes a lot of time, I guess. I don't know. I haven't installed this for like a year now, so I've completely forgotten what was on.
Just one question. This keeps saying time remaining. Is that important?
No, don't worry. I'll extend it. I can extend it from here. Okay, so WizIQ, yeah, it needs to be booked. I just need to kind of create a webinar so that people can. It basically allows allows this to be like an online webinar at this time. It automatically records it. The Google Hangout last time I used was a difficult thing, so we weren't using that.
It seems to be quite a big app.
Oh, it's a huge app, is it? Okay. If you want, I could show the chart here, but I don't.
No, I think it's just getting over now.
Okay. Yeah, I think I'll do that. I mean, next time I'll just create him as administrator or something. There was a problem this time. I thought it will be like fairly smooth, but it looks like it isn't.
Okay, another thing which I wanted to explain was, I said why long options is mostly done by retail, whether this is very less. That is fine, but then long options work only when there is momentum. Whereas market is, there's a number which says that almost 60 to 70% of the time market remains sideways or range bound, and only 30 to 40% of the time market is in momentum. I mean, it's in a trend. So that is also something which is visible on the options chart, whether we are going to get a trend, even if it is not fast. Maybe, okay, yesterday's speed was not expected. No one can say it was expected. But even if we have an idea that in the next couple of days, okay. If the charts are showing that in the next couple of days we will revisit 8,500, which means there was an indication that the long option, the long call will pay. Whereas that is where the straddles come into the picture, where it is quite clear for me that the Nifty might remain range bound in this 300-point range. That's where the straddle plays a part, where selling options which are higher priced will erode in value because of the time value going down, and maybe towards expiry, let's say if the expiry is 8,500 and 8,600 straddle which we sold at 228 average, I mean total of the call and the put, might expire at 100, or let's say expiry is at 8,600, the straddle will expire at 0. So that was the idea. Okay, so which strike price? That only depends on how many days are there to expiry. If let's say we were talking about expiry, let's say we were on Thursday, instead of Thursday, let's take an example that it was Wednesday and expiry was Thursday. and Nifty was at 8,380. There was no way I would have taken 8,500 calls because the expiry was. Okay, I think that's installed. He's telling me to download. I have already downloaded the app, installed it.
Oh, it's working? Is it? Or
No, I
maybe
downloaded it, installed it, and again clicked on the sharing. It keeps telling me to download again.
oh, I think you got to launch it again. You got to go off and launch it again. Let me just do this. Let me.
So should I go out and launch the?
Launch it again. I think it doesn't recognize.
Okay, I'll log off and log in again.
Okay.
Just give me a minute.
Cool. So AP will be back in a second. Okay, one of the things that we want to do here is look at the reasons of why you would do some of these. Can you hear us? Can you hear me? Voice is breaking. There was a little too much of the bandwidth issues. Okay, so so one of the things that we got to do also, and we're going to publish this a little bit, is also about how much premium you can get as a percentage of the stock price. And Sunil asked us about this. So if you get for instance, a call option at the money, and if you look at something like, to give you a quick example, perhaps I could share the screen here. So let me share my screen. Your okay. Here you go. You should be able to see this. So we're going to go to the NSE site and look at the option chain on their equity derivatives portion. This shows you on the left hand side calls, right hand side puts. The stuff that's shaded is in the money, and the stuff that's shaded, not shaded, is out. So sorry, we're at 8,509, I think, or 18 on the Nifty. And oh, now it says recording in process. Oh goodness, this is very strange. Sorry about that. So I'll just try and get AP back. Meanwhile, okay, so it's going to take a couple of minutes. Or I can do one thing, is I can quickly send a Google Hangout request. Does that work? Meanwhile, I can just show you quickly how we can find out what's happening. So for instance, 8,550, if you're doing a call, 8,500 call, you're going to pay 114 rupees 80 paisa. 18 rupees out of that is intrinsic value, because in Nifty is 8518. You're effectively getting a time value of 99, about 100 rupees, right? 100 rupees is for 8,500 as a percentage, 1.2%. You're getting 1.2% for 14 days. Effectively, that's one way to look at it, because you can say that, listen, I'm going to try and write this call option for getting 1.2% for 13 days. I can go one level further at 8,600. I get 63 rupees. There's no intrinsic value. I'm actually getting 0.8% of 8,600 at 63 rupees for the next 13 days. So 13 days is approximately half a month. So I'm getting 0.8% for half a month, which is about 1.6% per month, about 20% per year. May not be great, but you never know if it's a good opportunity. You can do straddles. So for instance, 8,500 straddle is 72 plus 114. So around 186, 187 for both sides. 187 rupees gives you approximately the 2%, 2.2% for 18 days. So assuming that the Nifty expires exactly at 8,500, you will make 2%. If it expires a little bit here and there, you will make lesser. If you write the straddle. Okay, I'm going to stop the screen. I'm going to try and